Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show.
Hi, everyone. Welcome to another Tuesday night. We are so grateful to have Dana Dunford back from Hemlane. Dana, thank you so much for giving your time. I know you are very, very busy. Why don't you tell us a little bit about yourself?
Yeah, so my name's Dana. I'm actually on the opposite coast of Todd and Melissa. I'm over in San Francisco, so the Bay Area. And I work in real estate, specifically property management. So we do property management nationwide. So after you purchase the property or decide to rent it, I look at all of those trends, everything from rental rates to rent increases to dynamics between landlords and tenants. So here to kind of share what's going on from that perspective, as well as also what's going on in the technology world. Since we are a property management platform, we also work on technology, and I work with the tenant engineers and designers and product folks as well.
Awesome. Todd, do we have you back?
Guys, I think I have solved my issue. Yeah, you have me back. I'm good to go. So a little panic there. I was hearing like double and triple and whatever, and thought maybe I was no longer with you guys. But anyway, guys, we appreciate having Dana on, and the importance, because we find where the heck all this housing inventory is. I mean, it has been easy. We're in the middle of our spring market. We're in April, and inventory actually get worse. And guys, I have a feeling that I know where it is, and I think Dana's going to help us to that. But more importantly, too, we're going to talk about how the market, we're looking at shelter inflation, right? Completely out of whack. Jay Powell, our Fed, is saying that we need a housing correction. Shelter inflation has been really driving the problems in America because people can't afford their housing. They can't afford to rent. They can't afford to buy. So the big issue that is coming up is that if prices are going down, and a lot of these landlords have just bought property in the last couple of years, they bought it at the top. And it's institutional buyers too. It's not just mom and pop shops. And now, and it's interesting because we're also going to have Dana. She was affected a little bit emotionally by SVB. There was a scare there for her back on the March 12th weekend. But really, with what we're hearing in the news right now is the potential crisis, the commercial real estate market crisis that could be unfolding. And this may affect a lot of multifamily landlords too, because they have commercial loans and they could be up for renewal. Vacancy rates could affect it, stuff like that. So anyway, Melissa, thank you for covering me on that.
Yes, of course. Hi, everyone.
Out of
Melissa
whack intro.
Levy. Yeah, that's okay. It's okay. We're here, and it's a live show, and this is what comes with the territory. So all good. But yes, everyone, Melissa Levy here at Sachs Realty, Todd's assistant. I'm with you every Tuesday night, filtering through your questions and comments. And again, I see them coming through. So we'd love to hear from you and what you experience. If you're a landlord as well, we would like to hear what you are seeing on your end. But looking forward to another great show, Todd. Thank you.
Yeah, we only have Dana till she's from the West Coast, so we have her to till 5:30 if you're on the West Coast, and to essentially 8:30 here. So, guys, if you have questions, go ahead and chat those in. But we'll jump right in, Dana. And I guess the first question that is on everybody's mind, with Jay Powell saying in his last FOMC press release, his press conference, he said that he is seeing rent softening with the new lease signings. And, one of the things that he said, the stickiness there is that, a lot of these tenants are in leases. And we know, you and me know, in the business side of things, the landlords aren't just arbitrarily dropping their lease rates. The way these tenants are getting cheaper rents are packing up and moving. So can you just tell us, what are you seeing in the data? Do you see rent prices coming down?
So rent prices are increasing month over month, but they're not increasing as much as you would expect. we're hitting a very important time from a seasonality perspective where you would expect them to go up. So, if you look at, November and December, you're obviously going to be seeing month over month a softening, fewer people moving. It's the holiday season, but then you expect it to pick up. And what we have seen is it has picked up where there's 0.5% month over month increase from February to March. However, the problem is that it's only increasing 0.5%, and we would have expected it to increase over 1%. And so the reason that I bring that up is it's not as high as prior years. And that creates a difference between landlords' expectations and tenants' expectations. So if you're a landlord, you remember last year, you were increasing rent prices by 3% easily. And you were thinking, hey, there's some landlords increasing their rent by 5, 10%. Now, suddenly, landlords are still thinking that, but in the tenant's mind, they're looking at what is out in the market. They're seeing it soften, and they're expecting either flat or very small increases. And so the reason that I bring that up and why it's important to look at the numbers is to make sure that as a landlord, you don't decide to increase it too much and have the tenant move out. And the reason I mention that is because vacancy will obviously increase or reduce your cash flow. But on top of that, we're seeing a softening even in the vacancy market. So we're seeing days on market much higher. So it used to be, that it was on average 32 days on market. And that was across the nation. Hemlane's numbers are obviously slightly lower. But now what we're seeing is that 32 has gone to 38. So 6 additional days on market. We're also seeing fewer applications per property. So it used to be an average of 11. Now we're starting to see 8 applications per property. So when you look at these comparisons, the reason it's so important to look at it is to incentivize your tenant to stay in and know that the high inflation and the high rental rates of 2022 are no longer here for 2023. And you do need to adjust and correct for the time period and where we are today.
Yeah, as being a landlord myself, I mean, one of the last things that you want is a turnover. So, you do have to ask yourself a question, even if you're in a current lease that says 3% annual increase, you may want to reconsider that because, or at least be communicating with your tenant. But if you look at it, even 0% increase, it may be better than, going in, repainting, putting new flooring in, changing out appliances, and risking another 30 days or losing an entire month. I mean, if you have a $2,500 a month rent and you, like you said, you take it down, you have 30 days that you're not renting the property because you're going in and getting it ready again. And then it sits on the market for another 30 days. You're losing, if it's $2,500, $5,000. That's a lot of years in 3% rent increase to, grab that $5,000 back, potentially. So, you had mentioned something about, before I ask that, in the data that you're seeing, and you're seeing that the days on the market is extending, are you seeing that there are price reductions? So when they're entering the data in Hemlane, are you able to see during that extra 6 days on the market or whatever that it's taken to get it rented, are you seeing that prices are declining in that time period?
Yeah, so I don't see them reduce the price year over year, but I do see that landlords' expectations are totally misaligned, where essentially they go through and they put it on market at a 5% raise or whatever it is, and then they have to go back and they have to reduce the price. And keep in mind your customer's experience. Your customer is the tenant. The tenant goes on to Zillow or wherever they're looking, and they can actually see that history that you've reduced the price. And then they think, ooh, I could even negotiate the price further down. Clearly, they're having a difficult time renting this. And I think that's really why it's important to listen to shows like this and understand what are the trends and have a realistic expectation on your property. And again, it does not matter what you think. It does not matter about your desired cash flow. It matters about the tenants and the market today and what you're going to get and how to maximize that cash flow. And it might not be the number that you had in mind from a year ago when I think, Todd, we last spoke and we saw this, hyperinflation, record rent rates, that is definitely softening in this day and age.
And it has to be because of the amount of properties that are out there also. I mean, one of the things I want to dive into, we were talking a little bit before we went live, is, the lack of inventory. I mean, like I said, we're in the middle of the spring market when in the real estate industry, people are saying, well, things are normalizing or we're getting back to normal. It's so far from normal. I mean, normalizing would mean that this time of year, we're seeing for sale signs go up in record numbers, right? Increasing every week. And in fact, every week we're seeing a decrease. And we know the housing market is interest rate sensitive, and that backed a lot of the buyers out. But we've also backed out a lot of the sellers. So we've had buyers and sellers back out of the market. And you were kind of going through some of that information. When we saw 2020 hit, when the pandemic hit, and we saw stimulus and 0% Fed rates, almost 0%, and 3% mortgage rates for 30-year fixed rate mortgage, we watched a lot of people go into the short-term rental business. We watched them buy vacation homes, things like that. Are we seeing a potential glut of this inventory that has been bought up by default landlords, like you were saying? Can you just kind of go over that?
Yeah, so I think we need to separate on the demand side the market associated with buy sell for purchase and then those for landlords. There's a couple things at play there. One, moving. And I'm going to categorize it. The first type of move you would have is a tenant who moves out of their home to purchase a property, right? We're seeing fewer tenants do that because of the interest rates. And so last year they thought they could buy a property. This year they can't. And so that's one thing that we're not seeing a lot more purchases from that perspective. So they're staying in those homes that would have freed up for new tenants. Then you would say the next thing that you might have at play to increase this housing supply of like even rental properties is new landlords coming into the space and purchasing more properties to make them rentals. Well, what happens as a landlord is that you go do an analysis. If you're a real estate investor, you go look at cash flow. And the variable that has changed the most is interest rates. And so what you would have purchased a property at a certain price, you would have had a much different interest rate a year ago. And that interest rate from a year ago, you would have honestly been able to potentially cash flow a property that today you no longer could. And so that's important because that inventory is not coming on market. And you're seeing these tenants who are staying in their properties, more properties not going on market. Now, here is one thing, Todd, that's a variable, and I don't have like nationwide because it's really hard to get the data on it, but a variable that actually works in the favor of increasing the supply of rental properties, and that is accidental landlords. So what you will see is someone go out and they might need to purchase a new home, but they keep their current property. They say, I could sell it or I could rent it. And when they look at the rent versus sell, it makes so much more sense for you to hold on to that property and become a real estate investor. So become a landlord because you're locked into this interest rate of 3% or somewhere around there from historically, whether you bought at that interest rate or you refinanced. And they're saying, "Nope, I'm scared of the sale market now. Like prices are fluctuating quite a bit. let me just keep it and become an accidental landlord is what we call them. And so that actually kind of balances out with those first two that I mentioned. And so from that perspective, from a nationwide perspective, we know that there's less demand from tenants for these properties, right? Like the days on market are increasing, number of applications are fewer. But at the same time, we are seeing this accidental landlord as a new trend that sort of makes up for it.
Yeah, I mean, just in the last couple of weeks, I know people that have actually moved and have done just as you're saying. I mean, they have interest rates that are in the threes, the low threes, and they're saying, why would I sell my house right now? I may need to come back to it. And in one particular instance, the client rented a house in another city and is putting a tenant in the house that they're purchasing. And we're seeing this. And that's inventory that would otherwise be on the market for sale.
Mm-hmm. Yep.
What do you think is going to happen? I mean, all of these accidental landlords, landlording is not easy. I mean, I know, you have a great platform for just that, the mom and pop or accidental landlord that kind of guides them through the process. But it's still, I mean, finding the right tenants that aren't going to destroy the place, that are going to care for it as much as you do, understanding what they need to do legally with rental licensing and, staying on top of that type of thing, the maintenance side. There is a lot of risk to it. I mean, do you think that a lot of these accidental landlords, I mean, this is a new thing, right? This is probably, because a year ago, you would have sold that house, not had to fix anything, right? I mean, you would have sold it with all its problems. You would have gotten $150,000 more than you should have. And you're like, wow, this is great, man. We've got tons of cash. Why will we mess around? But now they're thinking differently. So is this a good thing, a good way to look at it? They're emotionally attached to it. Is that good?
Yeah, I think they fall into two different categories. So one, before I go into those two categories, A and B, I want to talk about that point of being emotionally attached. I think it's a terrible idea to take a property that you lived in, that you are emotionally attached to, and make it a rental property, 1031 it, and get something else. And the reason is because you make decisions that aren't financial, you make decisions that are emotional. And that is the worst thing to do. So I just want to point out that, because you lived in that property, you might say, my property should rent for more because I have this side gate, or I have granite countertops and the other place doesn't. That doesn't matter as much to tenants. They're like, how many bedrooms does it have? What's the price? Right. And so from that perspective, I think you should 1031 it and get another property, a like property, if you're landlording it now and you have that emotional attachment. I think an emotional attachment is not a good thing to have. But I think they fall into two categories. I'm going to talk about A and then B. Categories A is you start landlording and you realize the value of purchasing real estate and you get addicted. There are accidental landlords that we have worked with who started with one property that was a home they lived in. And they said, wow, this is incredibly easy. I'm making more money off of this. Tenants are paying my mortgage. And it's a delightful way to invest in money and give someone, or make investments. So get a return on investment and give someone a home. And what happens is the more important thing is they go out and they buy more rental properties. They get addicted. They call Todd and they're like, Todd, where's another investment property? I want to buy more. That's category A. Category B is the other one that you mentioned, where they decide to sell it. And here's where I think we are. Everyone emotionally is still, they're always in their mind, like a consumer is always 10 months, 12 months behind. And so what I mean by that is there was this kind of shock in the market about interest rates, where everyone was comparing it to what happened last month or 3 months or 4 months ago, when suddenly they were like, but interest rates used to be at 3%. Now they're at 6%, 7%. I'm not going to buy a property that's too high. And what the only thing to change that mentality and to tell people to buy is time. The more time you have where it stays at 6 to 7%, sort of fluctuates, the more you have people say, this is the new norm. This is now the new norm. And I'm just going to have to suck it up and say, you used to be 3% interest rates. We're not going to be in this low interest rate climate again. Let me go and just make a decision, whether it's financial, whether it's personal, to go buy a property, or sell a property. And so I think what happened was big drastic changes like what we saw really just softened the market, stopped the market, put this halt because people were so shocked by the change. But I think through time, people are going to say this is the new norm. They're going to go out and purchase properties. They're going to go sell properties. And so that's that category B. Landlords who say, I was deciding to rent the property for a year because of the interest rate climate. But now, you know what? I am going to sell it and I'm not going to be a landlord. And there's nothing wrong with that, but you do need time. It's sort of like a breakup, right? Like you break up with someone, you're so emotionally attached to them, can't believe this happened. But over time, it just gets, you're like, whatever, why was I with that person? It's the same thing with interest rates or anything. Time will just tell, and people know it's like, no, it's not going back down to 3%. You're not going to get that anymore. Just deal with it. And so I think timing is a huge thing for that category B. So I think either way, the accidental landlord is a good rise to see like, hey, should you invest in real estate and purchase it? But I would also argue that you shouldn't be emotionally attached to it. And if it's a property that you lived in, consider a 1031 because you'll be a much better investor because of it.
Yeah, and Dana, hope that if you were category B and you decide to sell it in a year, that you had a decent tenant, and now you don't have to go in and spend $30,000. I was just walking through a investment property for one of my clients, and the tenant's been there a couple of years, and there isn't anything that doesn't need to be fixed. It's completely, there's a lot of work to do in the place, and we see this all the time. So, and this is category B, where, it was a primary residence, and, they need to, they've come to the fact that they just don't like, landlording. So
Yeah.
one thing I want to talk about is, what do you see about the potential glut in the multifamily side? During the pandemic, there was so much that was under construction. And these units now are being delivered. I mean, if you flew to any major city, that's where all the cranes were. And they were building these apartment complexes, a lot of them, around universities, not student housing necessarily, but multifamily housing to support student housing. But the question is, do you think that a lot of these operators that have raised the money, through the last couple of years, not promising, but suggesting double-digit returns and delivering that for a lot of their investors. But now that, they were buying the property at, cap rates that were way lower than we've ever seen before, and they were hoping that they would get more rent because they would go in and enhance the property and add a lot of amenities to it. What do you think is going to happen? Do you think we're going to have a glut of multifamily housing in the U.S. as this inventory is coming on the market? And then how will that affect the single family market when they can deliver that product, that 3-bedroom, 2-bath, or 2-bedroom, 2.5-bath apartment that is so amenity rich? Is that going to crush the single family market?
Yeah, great question. So I think, and when you say crush the single family market, I think it will enhance it. And here's why. Hybrid work and almost remote work is here to stay. We thought people might be going back to the multifamily and to the city environment faster than what we have seen. And what we found is that when you only have to be in the office one day of the week, people are okay with you working from home, all these sorts of things. Suddenly, folks want more space. Then you have self-driving cars coming out. Obviously, this is like 5 years out, but you have self-driving cars come out, which again makes it much easier to get around. And so I think I'm still very bullish on the single family home market. I think the multifamily market is going to experience some really hard times where, it remains flat. It doesn't go up. You don't see this huge spike in growth in it. And I think part of that has to just do with the new norm of what is normal for someone who wants a place to live, a place to work, etc. So I'm actually much more bullish on the single family home market than the multifamily.
So what do you think happened to along the line of that? And, and I know we had spoken about the bank collapse back the weekend, the March 12th weekend. And, you had said that was a pretty rough weekend because, you guys were in Silicon Valley and, that certainly affected you. And you were even afraid you could tell the story about your mom with the payroll and stuff. Why don't you just tell everybody let everybody know? I mean, because then I want to talk about if this multifamily sector goes through this hard time that you're suggesting, and I believe it too. What is that going to do to our banking industry? But tell everybody, I know we only have a couple more minutes with you, and then guys, then we'll take a lot of your questions and you'll have to chat them out for Dana, and we hope that she'll follow up on the comments after the
I
show.
will.
But Dana, tell everybody about your weekend scare.
Yeah, so this is with Silicon Valley Bank, and then I'll go back to what does this have to do with real estate. So just as a reminder, Silicon Valley Bank went under, and this was exactly a month ago, right, that this happened. And what was really interesting was the timing of it. Folks had said Silicon Valley Bank on Friday morning stopped wire transfers, went under FDIC. They basically took over. What people don't know is that had already happened on Thursday. On Thursday, wires were cut off at 2 p.m. And no one knew that Silicon Valley Bank was going under or had any suspicion of it until Thursday morning. And so it was basically for those of us on the West Coast, which is majority of tech companies, majority of those who bank with Silicon Valley Bank, you basically had 4 hours to get your money out of Silicon Valley Bank. And what happened for us, which was really interesting, it saved Hemlane, but I'll tell you about my second scare. My husband had actually received a call, and that person said, I just took $4 billion out of Silicon Valley Bank. And he had just wired $4 billion out that he had managed. And he told my husband, isn't your wife in Silicon Valley Bank? I recommend she takes her money out. Now, this was at 6 a.m., so no one on the West Coast was open. And that actually did save us, because what ended up happening was we did get our money out, but we quickly realized around 9 or 10 a.m. on Thursday that we had no idea it was going to crash so quickly. I thought we would have until Monday. But what I did really quickly realize was, because we reached out to JP Morgan, we reached out to Bank of America, we reached out to all these banks and said, can we open a bank account? And they said it's going to take 24 to 48 hours to open a commercial bank account. That's just how it works. So any other company that would have been in our situation, which was most tech companies, would say, okay, great, 24 to 48 hours. Sounds good. Not sure if this bank is going to crash right away. I'll wait until Friday or Monday. Because of that call my husband got, he was text messaging me saying, do you have a new bank account open? Do you have a new bank account open? You need to wire it. I don't care where you wire to, you need to wire it. And so what was good about all of that was we told every bank, you don't understand. You need to totally get rid of your know your customer and just bypass that and get us a bank account open. And what was interesting was we knew some people at First Republic who basically said, Dana, we know you. We've gone to dinner with you. We're going to bypass that and open your bank account right away. And that saved us because then we transferred. Now, everyone else was in complete distraught on Thursday when they found out they had no money. There were founders I knew who had $50 million, couldn't even pay vendors on Friday because they had no money. For us, we were safe in First Republic, but then I got the call on Friday morning that said First Republic might be going under. So then you can imagine that there was this scare until Monday. But like, how does that relate to real estate? That crazy story. How does that relate to real estate? So on, Sunday night, I was still nervous. I couldn't make payroll. As Todd alluded to, like my mom was like, how many team members do you have? How many employees? Like, how many people do we have to pay? What can I do to help you? Type situation, because we had no idea if our money would be safe by Monday morning. But on Sunday night, when they came out and said, the Fed basically said, we are going to insure all deposits over 250,000. So all your money is safe. Your millions of dollars that all these companies have, it's safe. I think that set the precedent, and it was a good thing. It was something where it was like, wow, the government finally stepped in for a good reason. We pay our taxes for a good reason. And the good thing about that is I do think you're right. The sector could be at risk. We've seen some defaults. I was just out to lunch with a multifamily person who's been taking some defaults and bidding on them at low prices because of that, especially it's commercial, but also some multifamily. And I think that this has set the precedent that the banking system will be safe. We will get through it. The government will step in to ensure that folks know their money is safe in the US. And I think that's a good thing. So I'm slightly more bullish than I otherwise would be, in part because of what we went through and knowing that the government was able to step in.
Yeah. Well, we know you need to get out of here, so we'll let you go, but we appreciate you guys. Dana will check the comments, so go ahead and comment your questions. We're going to answer some questions as well. But Dana, thank you so much. We love having you on our show, and we'll talk to you soon.
Thanks so much for having me.
Okay.
Bye.
Thank you. Bye-bye.
Wow. So, can you imagine? Oh my gosh, wondering whether you're able to make payroll because of your bank collapsing. Dana was just saying, Melissa, talking about, thinking that the banks would be safe. And I think the big concern that what I see is that a lot of these loans that are up for renewal, these commercial real estate loans, and this affects, if you have a multifamily building, more than 4 units, that is considered commercial. Mm-hmm. And, even less than 4 units, it's still considered commercial from a lending standpoint because it's non-owner occupied. Now, for the accidental landlord that moves out, that has a 30-year fixed rate mortgage, that's a little bit different. But for people, like myself, small landlords that, have mortgages that are commercial mortgages all the way up to, these multifamily, these big operators that have, commercial real estate loans through banks. What happens is when their loan comes up for renewal, they have to requalify. And, and what that means to requalify is that they're going to come in, they're going to appraise the property in a lot of cases. They're going to want to see your profit and loss. They want it every year, but they're really going to be honing in on, do you have vacancies? Are you losing money? Are you profitable? And a lot of times these banks, what they're going to do is they're going to come back and say, look, in order to refinance this loan, now your interest rate's not 3.5% or 4% anymore. It's going to be 7.5%. So their interest rate's going to in some cases, double. And they may look at the property and say, and for us to rewrite the deal, that with the numbers that you're showing, we want more cash out of pocket. We want to reduce the loan balance so that they're a little bit more comfortable rewriting it. And I think this is where the problem is going to be, because a lot of these operators don't have the money. Mm-hmm. And so what I'm thinking about is, banks don't want to be the landlord. They don't want to own real estate. They're in banking and lending money. They're not into owning it. And I think that the banks are going to get a lot of this back. And then what we saw in the '08 crisis, 2010, 2011, what we saw was, you could actually walk into a regional bank or local bank and look at their real estate that they have, basically foreclosed on, or loans that were non-conforming, and you could actually buy those for nickels on a dollar in a lot of cases, and which hurts the bank. And, so I think in this SVB scare or the banks collapsing, A lot of people pulled their money out of these regional banks and went with the big Bank of America, the J.P. Morgan, Chase, the Wells Fargo's, those types of banks to the tune of billions and billions of dollars. So I don't know how much these regional banks can take. Yeah, you may bail them out as far as the depositors, but what are you going to do when they own all this defaulted real estate? That could be another complete, issue in itself. But anyway, let's take some questions.
And I see a lot of comments here too saying like, where is the crash, the hype of the crash? And what people don't understand is that this does not happen overnight. We've talked about it before. We've talked about the timeline. We've talked about how we may not even begin to see any of this until towards the end of 2024. So I think that, again, we're all so focused on 2008, but 2008 took years. So I just, I think that's something to keep in perspective.
I think the only thing that is really establishing the floor on the market right now is the fact that two things. Number one, the jobs market is still strong. We haven't seen the layoffs. We've seen a lot of layoffs, a lot of white collar job loss. But the job market overall is still really strong. They're now talking about a mild recession, but we have a couple things playing out, but the floor really at this point is we just don't have any inventory. And I think one of the things that, Dana was saying as regard to the inventory is sellers aren't selling their houses. I mean, we're going to record a video here tomorrow that would be released this week that we're going to dive into some real data that shows a lot of what happened with the home inventory and what is going on. And Dana alluded to it. The sellers or accidental landlords are not selling their properties. They're moving out. They're, either renting or buying because they're moving domestically to other states, and they're holding on to their home. They're not selling it. So a lot of owners now own 2 homes or 3 homes, and we're not used to that. So it's not just the investors, it's the accidental investors with people just not willing to cut their house loose with this shock of not being able to make the profits that their neighbor made. And, and with the buyers, for every 1% change in mortgage rates represents about 10% of a home price. So, as we're watching those rates go up, we're watching the affordability drop. For every point it goes up 10% on average of, purchase price or purchase power. So we're in kind of like this holding pattern, but we can look at the facts that we know. We know that with all of these rentals, with all the short-term owners, short-term rental owners, Airbnb and VRBO, and a lot of these sites are posting, that rates or actual, rental income is starting to decline because of the amount of competition. And so as we start seeing these people that are expecting, higher returns actually not making the money with the cost rising, we're going to see a lot of that inventory probably hit the market. And then the other thing is, getting back to the crash, is that, there's no evictions. I mean, no foreclosures. Mm-hmm. I mean, we're still seeing, though we're double on foreclosures over last year, it's ridiculous. It's still nobody's being foreclosed on. And, the FHA is responding by saying, well, we're going to extend, recast the balance to 40 years now, for people that are still in default or defaulting. And so they're still kicking this can down the road, and eventually it's going to catch up. And a lot of people are predicting, that we'll start seeing a lot of this inventory if unemployment, if the recession eventually hits us, which they're saying, the Fed's now saying a mild recession. If this recession happens and we start seeing job loss, or we start seeing people lose one income, keep in mind the people that have bought over the last 2 or 3 years, most of these buyers are multiple income buyers, 2 income buyers. If we start seeing anything happen to one of those incomes, these people will not be able to afford their mortgage. They will be underwater. And if they purchased in the last several years, they will be underwater and they will be foreclosed on. And, unfortunately, this will be inevitable, or we'll start seeing people selling it quickly because they lost the job. They need to sell ahead of time. They don't have 6 months of, to get through, of cash to get through. And we'll start seeing these houses hit the market. But, it certainly doesn't happen fast. We're probably looking at, the end of, probably 2024 before we really start to see this thing play out.
Darren Buttery made a comment here. Losing a job does not always mean losing a home. People can get unemployment, side hustles, house hacking. People will do anything they can to not lose their 2.75% interest rate on their home.
And Darren, but not everybody's, mind thinks that way. I mean, it's, that's great for the entrepreneurial minds and the people, but, some people have a hard time going out and getting a side hustle. They don't even know where to begin. I mean, there's so much noise out there. You could start selling everything you have on eBay. But I think, starting side hustles is not as easy for many people as you would think, or they'd already be doing it and they wouldn't be in a position of losing a job, or they wouldn't fall in a financial position anyway. I mean, just look at the fact that that credit card debt is so high, the highest we've ever seen. If these people if it was so easy for people to go out that are in debt up to their eyeballs and they're paying 20% interest, 30%, 29.99% interest, it's going out the window. If it was so easy for these people to establish side hustles, they'd go out and do it. They'd be paying down those credit card bills. So, I mean, I hear what you're saying, and maybe you would be that one to do that, but people, they don't think that way. A lot of people, they're just not cut out for self-employment and the side hustles. Unemployment's not going to give you enough money to pay your mortgage payment.
I had a question here from Robert. If there is another bank run, do you believe the FDIC to bail out another bank, such as one who goes bust with bad commercial real estate debt?
So the Fed or the FDIC has said that there's now $4 trillion, I believe, is the number that they have established for banks to borrow at par. So I think the last thing this administration wants at this point is to have a big election year coming up and to see banks collapsing. So I think that the FDIC will step in, the federal government will make sure that the FDIC is prepared to ensure as it needs to, is my guess. But I think with the commercial real estate, the potential collapse there, I think that will be the issue with, I think what you're asking here is, will these banks that are taking back this bad debt, will they get bailed out? And, what we saw in the 2008 crisis is they were bailed out by being taken over. So I think that's where, the federal government step in and have the bigger bank absorb the smaller bank. So, and I think we've seen some of this happening with mortgage-backed securities and things like that recently in the news where, this is starting to take place.
Mm-hmm. We had, bear with me here, we had talking about, being a landlord. You had Randy D. having a good tenant who is taking care of the apartment is worth more than rent increases.
100%. I agree. And, and Randy, and I've felt that way. I mean, I have, geez, I think currently, I have tenants that have been in a property for more than 10 years in a multifamily property. I have not raised the rent one time. Now, this works to the point of at least you're having some type of positive cash flow. What is happening with a lot of these landlords is that they may have a perfectly good tenant in place, but they bought in 2021 and, their rental property, and they bought at the top. And now all of a sudden they realized, well, my property taxes have gone up. My insurance has doubled. The cost of repairs has gone through the roof. And now I think what they're looking at is they have to raise the rent. And for some of the tenants, they may leave. And yeah, you could lose that perfectly good tenant. But you're right. I mean, Randy, it's a great point. I mean, you're better off keeping the good tenant in your place that takes care of it like they own it, and being good to them, and as long as you can, at least.
We had a super cash super chat here. Thank you so much, NVSTR. Imagine becoming an accidental landlord and getting a bill for a major maintenance item mid-lease term. Already seeing rents decrease in large complexes. Rents go up forever until they don't. Beware.
Yeah, thank you so much for the super chat. We appreciate that. Melissa, you crack me up with your super cash. That's fine. She just includes them both. She said super cash one day, and we all made a joke out of it. Super chat, but thank you very much. That's very kind. We appreciate you. And yes, this is what a lot of people don't realize. It's very costly being a landlord. I mean, things break, and it's all on you. And that's the advantage. I mean, we're going to be looking at some charts in the video that we're recording tomorrow that will go over, in most of the country, the major markets in the country, the benefit of renting versus owning from a cost perspective. And what people don't realize is that home ownership is very expensive at times. And, yes, if you're prepared for it and you're going to stay there for a while, and this is a big, this is hard to get across to people because you never know how long you're going to stay. But we're probably in the riskiest time for you to buy a home if it's not a city or a town or a neighborhood or a place where you're going to plant your roots and stay there for a good 7, 10, 12, 15 years. And you are thinking to yourself, well, how the heck do I know where I'm going to be in 10 years? But there are some of you that know you won't now. And that's the key. What we hear people say, they go, well, I'm going to buy this because I don't want to pay rent. I don't want to throw my money away. I don't want to make a landlord rich. But then they say, but I'm only going to be here. This is okay. I'm happy with this because this is going to be a starter home and I'm only planning on being here 3 years. It's like, that's the worst. This is the worst time to buy a house to plan on staying for 3 years. Unless you think that you're going to build some serious equity in that house in the next 3 years, man, that's risky. So, in that case, it's kind of, you're better off renting. So we're going to look at some of those, charts. We're not going to get into them tonight. But yeah, great point here. Expensive. Heating and air systems. I mean, just doing change outs now, $12,000, $15,000, changing the inside and outside unit. Very costly.
Mm-hmm. Got a comment here, Todd, going along with what you say. Paying $50,000 to $75,000 over asking right now is like driving a new car from a dealership. Immediate loss guaranteed.
Yeah, 100%. I mean, look how many people have done that, right? I mean, Melissa, we watched it happen. I mean,
I know.
People were not borrowing; they were getting gift money from their parents, and basically throwing $50,000, $75,000, $100,000 over appraised value. The bank has an appraiser, that you pay, come in to protect their interest, and they put a value for the bank, and it's $100,000 less than your contract, and the bank says, well, you don't get financing unless you pay that $100,000. The difference between your contract or renegotiate it, which wasn't happening, and people were just forking it over. They must have, sometimes investors will do this. They will know what's going on in an area, like the Amazon, headquarters that came to Baltimore. Mm-hmm. I had property that was right up the street from it, and I remember when GM went out of business. It was in the GM plant, the old GM plant. The location was where Amazon built this monstrosity. And I remember that when I bought these houses, 4 houses in a row, 8 units. I remember, there was talk that something big was coming, and I mean, no one knew it was Amazon, but it was like if you could plan that, then you're going to have serious appreciation because of the amount of jobs that they were thinking it was going to be a couple thousand, and it'd be 5,000 jobs, and it just kept growing and growing and growing. They added onto their campus, and then a lot of supportive businesses grew around there too, creating a lot more jobs. And it really appreciated the area. But you would think that some of these home buyers have that kind of knowledge. They're like, I'm going to buy this house. I'm going to overpay it today, $100,000, but I know what's coming. Yeah, I know what's coming too, but they know what's coming, and what's coming is maybe not what they're thinking, unless they have that intel that magical build is going to happen right down the street, and it's going to just appreciate that property so much that they're buying today future profits for a time down the road. I mean, that's what investors are trying to do. These homeowners are just, I don't know, they're being silly, some of them.
Mm-hmm. They are. They were just so dead set on getting the house. They didn't care. They wanted it. And a lot of them thought that there was no end in sight, that it would just keep on, the values would keep on rising and rising. So they had to get in there before they went up even more as well. We have,
and I want to say one thing too, because some of the comments
Mhm.
are like, well, you guys, benefited from it too. I can tell you, we as a company, as this was happening, when they started getting rid of inspection, contingencies, I remember the first conversation that we had with one of the first, contracts that we had, where the cash was a cash buyer, came in, no contingencies whatsoever. And I remember having a conversation with my agent, and he was saying, you know what, almost 35 years in the business, I can't even sleep at night. You remember that, Melissa?
I remember this
it
was in the beginning of when the craziness.
And we started talking about it, and we started saying, look, we have to double down on this, and we have to make sure that we're advising our buyers. If we're representing the seller, hey, of course we're representing the seller. But when we're representing the buyer, we had to make sure that we were putting things in writing, that we were having conversations about this, the risks involved, giving them brochures digitally with proof of delivery that says specifically, for your protection, get a home inspection. I mean, boom, right? And they were signing off where they were willing to forego it. And, so, I mean, we were having these conversations. I mean, guys, I'm certainly not trying to toot our horn or pat ourselves on the back, but we were probably one of the first real estate companies to hit the internet saying that this is nuts. Like, what is going on is crazy. And, I mean, you can go back in our channel and see when we first started saying it. And, so it's not, they're time stamped.
Mm-hmm.
But just for those that are commenting, saying, well, you guys benefited by it too, understand, I mean, we were making certain that we were educating as a company, our agents, making certain that we were educating our buyers as to the risks involved with, buying such a big purchase with no contingencies and using all of their cash. But anyway, let's answer a couple more questions.
Yeah. We have Real Estate Mindset here. Always love seeing you every week on here. So thank you so much. Let me just add this up. Here we go.
Travis, I feel bad, man. I feel bad because I've been so overwhelmed and busy. And I know you and Orlando and Scott and Luke, man, you guys have been blowing it up back and forth with your conversations. And I've been absent in it, but we appreciate you. Thanks so much for your super chat, man. And we know you're out there working hard, guys. We have a nice little community, tight community that we try and all across the country, we try and just see what's happening in everybody's town with the markets. And so Travis, certainly we appreciate him out there doing his hard work and due diligence.
Yes. So thank you very much for that. And let me hop on over here. So we've got a question here from Jim Bob. As a landlord, do you see capital appreciation or rent increases? I see neither.
I think a lot of it is just going to depend on the inventory situation. So, I think that rental increases, I think we are going to see a flattening of rents for quite some time. Maybe, I'll be bold and say, it may even be a decade long, flattening on rents. It may be a decade long flattening on home prices too. One of the things that I'd said way back when on video was we showed charts of the home price through, the last, since like the 1950s and 60s. And we were looking at, each recession with the home price softening of every recession. And then what would happen after that. So we would either see, when we saw a spike, we'd either see another spike going down, or we would see a flattening off. And I'd even said, there were two scenarios. We either see, a major dip in, home price where we're seeing a real crash, or we see a prolonged period of flattening out, which right now in today's, without, a black swan event or without something, happening major, that's what we're seeing. We're seeing a flattening out right now from where we are. We've seen about a 10% in our area, decrease, somewhere 7 to 10% in home prices from peak to trough so far. With some areas we're seeing more, and some areas we're seeing less, but we're not seeing the craziness as bad as we did a year ago. So the indicators are flattening, but I do think that rent prices are going to flatten out with home prices as well. And I don't think that rent prices will crash as the potential for home prices to crash. And I think if we have, anything happen with our job market, if we see anything happen with our, these second homeowners, these accidental landlords, I think we'll see an increase in inventory like we haven't seen. It'll be a big spike. And I think that we'll see some softening in prices in the housing market, even more than what we've seen. But rental prices will stabilize because these people that are losing their homes will go into, like Dana had indicated, into these single family rentals. And so, but I don't think that's going to change the price necessarily of the rents. They're already getting top tier rents right now. Most landlords have, really hiked the rental rates.
There was a cool comment here. Bear with me one moment. You guys are having so much to talk about, but I thought this was cool. I love when you guys give insight from where you're living locally, but we had Doms here. What Todd is talking about, backtrack a little bit, Todd, to what you were talking about with Amazon. It happened in Sarasota. Amazon was supposed to build a huge warehouse and employ thousands. Then Hurricane Ian hit, and now Amazon has paused the idea for now.
Yeah, and Amazon was supposed to go in New York City too, and there was some kind of something happened, and politically, I believe, and they pulled out, and I think that really affected a lot of speculation, and so investors try and do that, and when I was more into the investor side of the transaction. I was a contractor and doing a lot of investing, building houses, flipping houses. And, what I used to do is I would go to, this is way before the pandemic, what I would do is I would go to the zoning hearings. And, I would tell my agents too, like, you need to go to these zoning hearings because there is a wealth of information. What happens is development happens years before a shovel goes in the ground. Because they have to go through the process, the community impact process, hearings and design meetings and things like that, impact meetings. And I would go to these meetings and I would see what is going on in my town where I was investing. and a lot of it was in Baltimore County. So I would go to all these zoning hearings, and I would just sit in the back and I would just listen. And they would say, undisclosed buyer, purchasing, 47 acres off of exit 36, and you could kind of put two and two together and follow it along and things like that. But then it got to the point where, I was sitting in there and I would meet the real estate attorneys. I would meet the engineers. They'd be like, hey, you're here like every single time. Who are you? And what do you do? And I'd give out my cards and then I would be, a resource and I would get to know what was going on and what they were trying to do when no one else knew. And then the whole idea behind that was, to try and strategize myself on where should I make the move? Like, where should I build? Where should I rehab? What's going to happen in the community? It's just smart business. Agents should do this every single day. And, but it can go the other way. You can start to, just like Dom's suggesting here, you could think, oh, this is great. Now I'm going to get my project going and my development going. And then all of a sudden you learn that they were rejected or they fought them and they backed out or whatever. And, so it can go both ways. You have to be smart about it, but speculation is a big play. And look, a lot of these home builders that we see that are struggling right now for sales. I mean, there's such conflicting data going on with new home sales. And we like to think that these builders are dumb. They're not dumb. A lot of these national builders, man, they have got deep pockets. They know what's up. They are pushing regulations. They are, they know what's going on, right? So what we've been seeing is though new construction can be affected. It's like the first indicator of where things are going because they don't live in the house, right? So when you see a builder, think about this, that is way smarter than me, that is building, investing hundreds of millions of dollars across the country and building communities. These builders, man, they have more analysts, Wall Street analysts backing them, as far as, checking their data, figuring out what's going on, knowing what's happening on levels that are way higher, right, than what we do. When you see them start to dump, that's when you know something's going on because they're not dumb, right? And so here's the thing. What we've seen is a lot of builders, some builders actually started raising their prices recently, right? They're going, you know what? We know what's going on here. There's no inventory. We know that these these accidental landlords are happening. We believe we've got the gold. We have buildable lots. We have the power, and we'll just get rid of people. We'll let people go. We'll let salespeople go. We'll let, executives go. We'll do whatever we need to do. But, we're not going to dump our inventory that we fought hard over the last decade to break ground in, or, we've put, tens of millions of dollars in infrastructure and roads and curb and gutter and drainage and stuff like that. So, that's really key leading indicators as to what's going on or what they predict. These, analysts predict what's going on from a macro level as you start seeing what these home builders are doing. And I'm not talking about just giving concessions, things like that. I'm talking about dumping properties.
We hear these type of questions a lot. The next one that I'm going to bring up here from No Thing. I have a home in Jacksonville area. Our rental tenants are almost up on their lease. Should we rent it again or sell?
How did you do? I mean, it's, and this is, this is the big question. What do you have to spend to get it ready to sell? Because, a lot of people can get a home ready to rent for a lot cheaper. For example, if you know that your heating and air system is at end of life, today's buyer is probably going to want you to replace it. So, have you made money? What's the condition of your home? What's it going to cost to get it to where you can put another tenant in there? And, what's it going to cost if you put it on the market? And what are you going to make? What are you going to profit by it? Eventually, from the history of time, home prices appreciate, right? Period. I mean, that's all market specific, but if we look back to 1954, wherever that, the Fred chart, I think it's 54 starts, and we look at the trend line, it's going up. So properties do appreciate location, the property value appreciates. It's just how long will you want to hold on to it, and do you need the cash? So there's a lot to play into that. But the big thing would be, what's it going to cost to put another tenant back in? Can you cash flow? What's it going to cost to put on the market? What can you sell for? If you want to send us an email, you can certainly shoot us an email more specific to your situation. And I think we do have a couple of broker partners in Jacksonville that we can get you some intel. There's my email address. If you want to shoot me an email, love to dive in deeper for you.
Mm-hmm. And then we have a tenant right here. Timothy, I prefer to extend my lease and keep my strong savings rate instead of jumping into this market. Savings rate is key.
Absolutely. 100%. Yep. I love that, Timothy. It's not, look, I mean, renting is not a bad word. I mean, it's appropriate for, people. I'm losing my voice. Too much talking today.
It's a lot of talking today. It's been
When I say
talking
it was
all day.
appropriate for people before I was needed to take a drink of water, it's appropriate for situations, right? So, there's no sense in going into debt, stressing yourself out, putting yourself financially at risk, because I could tell you, for those that make bad decisions and have to go through foreclosures, it's a really bad experience. And a lot of times, we're taking other people down with us, and it's tough. It's tough.
Had another comment here. Scott Allen, thank you so much for your opinion. Unemployment percentage has to rise in this anticipated recession to see a surge of inventory in real estate. Only then will the housing costs dramatically fall.
Yeah, I mean, unemployment is certainly one of those, key factors at this point, but it's also, like we have been saying earlier in the show, there's a lot of inventory from people holding on to the home that they lived in and becoming those accidental landlords because they don't want to sell. They don't want to give up their 3%, 3.25% mortgage rate. And so they're holding on to it and renting it because they can make a profit. They can look at it and say, my cheap mortgage, I can rent this, put $1,000 in my pocket a month. And, but they don't realize that it's not that simple. You can go backwards. You can eat up your profit too, but they're looking at it as a way of, hey, this asset, what am I going to do with my money? Do I put it in the bank? Do I pay taxes? Dana suggested 1031. There's a lot of different things that you have to consider if you turn that to, cash. So we're seeing that these people may end up selling, as their money's tightening because of the economy, and they're not making the profits that they were in the stock market. They're not making the profits in their, in their bank accounts. They're watching it dwindle away because our dollar, is worth so much less because of inflation. So these people are eventually, they may run out of money and be forced to sell. So it may not just be from a job loss. We have millions and millions of homes. Back, 20 years ago or whatever, we were selling like 1.2 million houses a year. And, now it's getting down to like, 400,000, things like that, numbers like this. And what's happening is millions of houses are sitting vacant right now, through Airbnb, VRBO, short-term rentals. I mean, it's a major amount of inventory that's sitting there vacant, just gobbling money up.
Had a comment here from Medic 311. The landlords who will be in trouble, those who bought at inflated prices with a lot of leverage at high rates for units that won't cash flow until rents substantially appreciate.
I think multifamily housing's in trouble. I really do. I think some of these operators that, bought, fourplexes and greater, where, they have commercial loans. I think their interest rates, as their loans turn over, their interest rates are going up, taxes are going up, costs are going up. Something we haven't even talked about. I mean, they want, there's a lot of legislation for the elimination of fossil fuels in these buildings. So, a lot of these older buildings that have, oil boilers and gas and things like that, they're going to have to convert those over. These are going to be very costly for a lot of the landlords. They don't have the profit sitting in the bank. A lot of these landlords have very little equity. They strip the equity out of their assets so that they could buy even more or spend it in lavish lifestyles. And, what's going to happen is, if this starts to get rocky, I mean, they're not going to have the money, a lot of these operators. And how do you raise money for the ship that has, holes in it that's sinking? How do you then turn around and say, do you want to lend me money or invest in this sinking ship? I think the banks are going to know it, and they're going to want more cash. And I think a lot of people are going to have trouble refinancing these assets.
As a follow-up on that, you've got big brother in life. I believe a majority of pre-foreclosures, foreclosures, short sales, and REOs will be from landlords.
I think so too. Yeah, I think so too.
In this comment here from this viewer, we were just talking about this earlier, Todd. Long journeys. I think it's insane how often people move nowadays. My grandparents stayed in their house from 1945 until my grandma died in 2012. I lived in the same house for 20 years.
And that's a big thing. So we learn by the experiences that we go through. And when we have downturns or we experience bankruptcies and recover from them, or have foreclosures and recover from them, or lose our businesses and recover from them, or lose our jobs and recover from them. I mean, we are resilient. We do, but we do end up making it through. But a lot of times, when we make mistakes that get us into these situations, and let's face it, a lot of the situations are from the mistakes that we made personally. Not something that just happened to us where we were victimized, but we actually put ourselves in this position a lot of times. And, so we have to learn by these mistakes. So when you see where people are, moving, making these moves and buying houses, and, the ones that just decided to do that for a 2 or 3 year home, or they have to move quickly, or they lose a job. Unfortunately, they may go through a very unpleasant experience of foreclosure. But when we watch people, go through the depression and go through war and, see, famine style, effects. And I mean, look, we got a taste of it in the pandemic when in 2 weeks, the grocery shelves were empty. Right? It doesn't take much, right? We recovered quickly for that. But can you imagine if we didn't? Can you imagine if that lasted for 30 or 45 or 60 days, the impact that would have on society, right? I mean, so, I'm certainly not suggesting it, but imagine if something were to happen to where we didn't have electricity for a month, right? So, not trying to add a whole lot more to this, but we're not very good at saving for a rainy day. We haven't been very good. But when we go through major downturns, and some of us never experience it, God bless you. I mean, if you've never experienced a downturn or a hard time, but when we go through these life-altering events, we hopefully learn from them. And if you get through it, which most do, you experience, I don't want to go back there anytime soon, right? So, yeah, I mean, watching people move in an average of 7 years or 9 years, or starter homes, or, I'm just buying a starter home and I'm going to move up and I'm going to do this and do that. That didn't happen before. Most houses coming after World War II were cookie cutter houses. Our neighborhoods are full of them still today. They were 3-bedroom, 1-bath homes, right? Very modest in size. They weren't 2,700 square feet. They were 1,200 square foot, 1,400 square feet, and smaller. And, how did we make it work back then? How did we raise 6 kids in a 1,600 square foot house? We did it, right? But you're right. I mean, my grandparents, my grandparents stayed in the home that I was raised in. They were in the home. My grandfather was in the house when he was a kid, right? Or younger. And, took it over from his parents. And, then married my grandmother. That's where they stayed until, my grandfather passed away, and my grandmother lived there to almost the day that she passed away. So, yeah, where we got into this society of, it's just for now. It's just for now. And I'm going to buy what I can't really afford, or because of how it looks, Melissa. We see it all the time.
I know.
How they look. Oh, well, it's got to be big. It's not that we need furniture to fill it, but we want to say we've arrived, we've landed here, and that's fine if you can afford it. But guys, the ones that there's so many people that buy above their means, and we've talked about it before on the show. We've had financial advisors that have told me one of the number one reasons why people are not ready to retire, why they're working longer in years, isn't just because they're living longer, it's because they can't retire. They didn't make the decisions. So we say, well, a home is an investment. Let me tell you something. Sometimes it's the only investment people have, but they have to sell it and move to get the money, right? I mean, they overspend monthly for their entire life, and that prevents them from investing in other areas to where they can have other income coming in as they get older in life. And we see it, man. I see so many elderly people. They're living in houses that have leaky roofs. They're living in houses that the heating and air system's about to collapse, and they don't have the money. They're on fixed income, Social Security. So, it's tough. It is tough. I wish I knew all the answers.
No.
Appreciate the opportunity to talk about it and raise the concerns and get your comments and hear you guys, talk about it too. We love having you as a community, and appreciate your support. Definitely.
Yeah, it is very special to do this every Tuesday. It really is. And the viewers and seeing how they communicate and comment to each other. It's pretty awesome. So we're very grateful for all of you. We had Hank Duncan here have a question. Do you know of any measure on how leveraged people are on average these days? Like, are people using a lot more of their income towards mortgage payments than in years past? What are your thoughts on that, Todd?
I'm hearing where housing costs, because of repairs and things like that, are getting an upwards of 60% of their income, which is crazy. It's not just your mortgage payment. Like I said, it's the maintenance cost. They're being, trapped in these houses. These people that have bought in the last several years, we've seen the biggest wave of buyer remorse that I think I've ever seen in the 30 some years of serving the housing market. More buyer remorse right now, because people don't have the money to make the repairs. So what are they doing? They're putting them on credit cards. I was speaking with somebody about a week ago that had gotten a home equity line of credit of $250,000. They're paying 8.5% on their home equity line of credit right now. They used it all. So, now they have zero equity in their house. They have expensive bills, and so that is a huge part of their income that is that they're working for, bringing it in. And so, yeah, I mean, I see where this is mounting up, and this is where we talk about the housing crash. I don't know how we don't have a housing crash. I don't know how we don't have it. I mean, there's all kinds of arguments out there, but eventually, what's going to happen? I mean, are we going to see massive wage growth? How will where's that going to come from? I mean, guys, maybe you know more than I do, but, where's it going to come from? How are we going to get ourselves out of this debt?
Yeah.
Well, we'll take a couple more questions and then
Yep.
wrap
I'm
it
going to bring up here. We've got Got Jeff M here. Everyone is paying for all these low rates through higher prices. And guess what? When all these lenders who handed out these low rates go bust, it'll end up on the Fed's balance sheet.
You know, Jeff, here's my thing with the lenders, I mean, you are right. I mean, banks. I think there's going to be a lot of bailout. There will need to be a lot of bailout. The question will be, who will be the landlords? Will the bank be the landlord? You know, will they just say, hey, look, you know, you've defaulted on your mortgage. We're not going to throw you out. You know, we will rent you your house. Now, you won't own it anymore, but we'll rent you your house at, you know, a price that you can afford, because we just want to keep you in there at this point. We own your mortgage, your debt. You know, we got some bailout money, and now maybe we can afford to, you know, we can still make a profit. But, you know, a lot of the originators, the lenders out there, and if you guys are listening, you may not like to hear me say this, but, you know, well, you probably like to hear me say this, but you won't like my opinion on it. But I can only imagine the amount of refinancing that's going to take place with this 40-year mortgage. And I think that if this becomes the norm, where, you know, we start, you know, getting used to hearing 40-year mortgage, you go buy a car, you can get a 7-year loan. I remember when it went to a 5-year loan. It was a 4-year loan on average. People were debating, do I do a 3-year loan? Do I do a 4-year loan? Then it was, okay, do I do a 4-year loan? Do I do a 5-year loan? Do I have to do a 5-year loan or a 6-year loan? And now it's, why would I do a 6-year loan? I can do a 7-year loan. So it starts to be ingrained as the new norm. So when we're looking at, you know, back in the day, if you wanted to own a house, you had to put 50% down. You had a interest only loan for 5 years or 6 years. And then basically, this is way before FHA was ever around. And, you know, the defaults were high because people didn't pay down their debt. And in 5 years, the balloon payment, they needed the other 50% of their home purchase. And the defaults were high, or like 40% in the 40s. And so FHA kind of stepped in and said, look, we need to change this. We need to extend the terms, lower the down payments, and that kind of thing. And then they started with like 20, 25-year loans. You know, now we're, you know, talking about 40-year loans. We've been doing them before. VA has been offering a 40-year loan. FHA just announced they're also going to cast these defaulting loans into 40-year loans. Well, these loan officers are going to get to rewrite this business from a 30-year loan to a 40-year loan. The question is, when does that become normal? When does it now become normal for everybody to have a 40-year loan? And then as people are realizing that they're struggling with their payments or their rates, you know, high rates, now they may get a lower rate to be encouraged to go into a 40-year mortgage. I don't know. I don't know what's going to happen next.
Had Real Estate Mindset here make another comment. Use data, not emotion. Things happen differently in different areas. Be cautious. If you find a home you love for a great deal, buy it.
Yeah, but Travis, we know people don't think that way. I mean, the residential housing market is a very emotional experience. And one of the things, I guess, that the industries have been pushing, and, you know, both the sales side and the lender side has been pushing a dialogue of payments. You're buying a payment. And though that is unfortunately true, that is what stings people the most. So that has been what is allowed the housing market to run away the way that it has. You drop the interest rates down to 2.74%. You can buy a heck of a lot more house, 30%, 40% more house for that payment. So it instantly allowed the equity, you know, the existing, home sellers to gain a lot of profit. And we've been pushing the narrative of buy the payment. Can you afford the payment? Can you afford the payment? That's the problem. The problem is, if anything in your life changes where you can afford, they say you can afford the payment today. They don't say that you can afford the payment next year. So what happens is, when you can't afford the payment, now the price matters. That's why in real estate, they always say buy low, sell high, right? Location, 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 buy low, sell high. They don't say buy a payment that you can afford, right? These rich folks that have used real estate to build wealth, they say buy low, sell high. Should that not be the case for the homeowners that are buying that sometimes it's their only investment they ever make in their entire life is their home? So, when we're buying at the top of the market and buying that, we're buying a payment. Oh, 6% is nothing. 7% is nothing, guys. It's been 7.77% over the eternity of time, over the last 40, 50 years. That's been the average rate. Well, when I bought a house back in the 1980s, I paid 16%. Great, right? Let's not focus in on the rate or the payment. Let's focus in on what are you buying, how much is it worth, and if you had to sell it in 3 years, can you get out from under it? That's the question.
And Johnny Fly made a really good comment here because this is exactly how I feel. I miss having a wallet with cash that made me think about a purchase I was going to make. And that's true. I mean, everything is just swiping, tapping, Apple Pay.
I look, I can remember having a savings account. Man, I would put money in a savings account and I would watch it grow.
Mm-hmm.
And that was when banks actually partnered with you. They didn't just take your money and make money with it. They actually believed in, partnering with depositors. That actually meant something to them. Having a relationship with a client meant something to them. Now, my gosh, you have to go in and give, eyeball DNA just to get your money out or move it because, they want to know why you're making a withdrawal. What are you doing with your money? It's my money. What the frick is it your business what I'm doing with my money? So, I mean, but back in the day, we used to put our money in savings accounts. Man, I can remember getting 7%. Remember watching it grow. It's like, wow, this is fantastic. But I guess that was also back in the day when everything had a stamp on it that mattered. It said made in the USA, right? I mean, it was like we had actual manufacturing here. We had pride of product. We didn't go buy products that we knew were going to break because they were junk. And we used them for 6 months and, oh yeah, right. Well, we know where we bought that from. They get these products made specifically for them and they don't last. We just know that. We accept it. It's just part of what we do. Right. But hey, look, and then we'll get the comments of people say, oh yeah, well, there's just, another, old timer, talking about the way it used to be, guys.
Yeah.
But hey, you know what? It was nice.
It was nice. Things lasted.
It was fun.
Yeah.
We had wallets.
Yeah. Yeah.
Not just to carry our fake IDs. It actually meant something. We had money in them.
Mm-hmm.
My favorite one was the zipper wallet because you didn't want your change to fall out. Put your quarters and nickels and dimes. Man, I can remember. I think I still pick a penny up. Mm-hmm. All right. Maybe not pennies. Maybe I'll
maybe not
on the ground, but definitely a quarter.
Critical thinker. I purchased a house in 2004 in a bubble in Los Angeles for $400,000 and it sold for $420,000 after 12 years. Same thing will happen for sure.
Yeah, that sucks.
Yep.
Yeah, I mean you would at least hope to sell it for $440 so that you could come out of it out of pocket with at least, thinking, man, at least I made a couple bucks. That's when we get in to say, look, you're buying a lifestyle, right? I mean, you're buying a lifestyle and owning a home. Excuse me, you're buying a lifestyle. So, do you rent a lifestyle? Mm-hmm. People are living on yachts right now, big boats and ships floating around. That's another podcast. We'll get into that another day. There's some people with remote work, man. They just want to live on a boat. That's a lifestyle. They're renting a lifestyle.
Mm-hmm. People who bought in the bubble, even at 3%, still maxed out, overpaid, and have tons of repairs. That was almost me.
Yeah.
Yep.
Yeah, that's right. And they took mom and dad out too.
Mm-hmm.
They said, we need $70,000 in cash. Can we get a gift?
Yeah.
And moms and dads said, yes, we want you to have a house. We want you to compete. We want you to be in that, win that 25 multiple offer situation. We don't want our kid to lose. We want them to win.
It comes
Get
down
it.
to image too. I mean, it's you have to fit on what society says to it. I mean, that's just another element to it. So we have Jim Bob here. Powell has signaled that the bank's credit tightening will help reduce demand and inflation. The problem is the time lag from when this rapid rate cycle started just a year ago. This has not unfolded.
Yeah, and we'll see just how much banks' credit is tightening. I mean, I think that the buyer pool is drying up. So, there are still people that are investing in mortgages that want to buy mortgages, and there will always be someone who will lend you money at a higher, riskier rate. So, I mean, look at hard money lenders. I mean, some of these investors have terrible credit. They've gone bankrupt. They still get the money. They get the money for what they want. But the hard money lenders charge points up front. They charge very high interest rates, and they lend money on the real estate that they don't mind owning one day should the investor default. And there'll probably always be someone to lend money. They'll keep tweaking the loans and then we'll probably get back to the no doc loans again. I mean, we already have like stated loans where you can just, show them bank accounts. You don't have to show them tax returns. You can just show bank accounts. You're self-employed, whatever. I'm not a lender. I don't want to get myself in too deep here, but I know they exist. Hey, do you have money in the bank? Can you show where you're putting money in the bank every week? Can you provide, 3 months or 6 months of bank deposits? We'll get you a loan. And there will always be someone there to lend you money.
Mm-hmm.
Let's take one more. I'm losing
Yep.
my voice. It's getting late at night.
It is. What time is it? 9:30. Okay, so we've got relaxing beats here. I believe it would be hard to default as a landlord when you can charge as much as you want, when so many potential home buyers can't get into a home.
Yeah, well, I'm sure a lot of landlords would love, and maybe this sounds good, but millions of millennials have gone back home to live with their parents and grandparents. We are seeing a rise in multi-generational housing, and so you can't always get what you want. And I can tell you that of the tenants that struggle the most, they can be the most destructive to your property. And if they feel that you're gouging them and that you don't care about them and you only care about the money in your pocket, they can make life really, really miserable for you, make it hard for you to get them out, and cost you a lot of money in the end. So, I've seen this happen, and, it's kind of like, it's about selecting, making sure that you have good, people that you feel are going to pay you and take care of your place, that have pride and care. But even those best tenants can turn and not care about you if they feel you're just taking advantage of them. I've watched it happen. I've seen it happen so many times, guys. And, great tenants are like, screw this guy. You know what? I don't even care. He's jacked the rate up on us. It's ridiculous. We know we're paying more than we should. And they kind of turn. So, and what we realize, and what we're talking about, let's say you're charging $300 more than you should a month. $3,600 a year. You have to spend $30,000 after they move out in 2 years. You lost. You think you're winning, you lost. You lost big time. Right? So it's a lot easier to default than you would think, because these landlords aren't profiting what you think that they're profiting, many of them. And they make bad decisions and it burns them. And they can't recover from it. Some of them, anyway. Well, we thank you guys. Thank you so much for tuning in. We love it when you watch our show and comment. And if you haven't subscribed to our channel, do so now. We love it when you subscribe, hit the alert bell. You'll know every time we go live and when we post other content throughout the week. Everything real estate related. We touch on some macro things too, and I kind of step out of my game and get into somebody else's game, and then you guys straighten me out on it. But anyway, I love it when you do it anyway. But Melissa, thanks for another Tuesday night.
Yes. Thank you, Todd. And thank you everyone for tuning into our show tonight. Always a pleasure. Always so great to be here. We are, thankful to bring you this content.
All right, guys, we'll see you next time.
See you next time.